Junyong from FSMOne Malaysia. Now, just now, Jin has presented the second half global outlook, where I understand that cramping all the global markets outlook, global markets movement within 20 minutes could be quite overwhelmed. But don't worry, in this session, the only role that I'm going to play is to help you to find your perfect match through our recommended fund list and also ETF focus list. Now, in the next 20 minutes, I will walk you all through our fund selection methodology and what is our past recommended fund performance before we unveil our recommended fund list in 2025 and 2026 as well as ETF focus list. Now, here is a simple disclaimer that I would like to make. Past performance does not indicate future returns, so please always invest at your own risk. Okay, for those who do not know, for your information, there are over 950 unit trusts listed on our platforms, where this year, we have scoped down the list to 43 in our recommended fund list. And these 43 recommended funds has covered 37 categories that I do believe that for investor, it can definitely help you to find something that suits your risk profile. So, here's a little information, a little background of how we choose our recommended funds and what are the considerations when it comes to unit trust selections. Quantitative. Basically, we assign different weightage to performance, to risk, to expense ratio, where performance simply means a report card, where it tells you how the funds can make it to you in terms of returns. But it's also not just as simple as performance. We also need to look at how resilient our fund is for you to withstand when the market hits you. So that's why the second metric risk is here. Expense ratio. Basically, many investors may overlook expense ratio simply because, but that's very important because expense ratio simply can tell you how efficient a fund manager is when managing the market. To elaborate, when it comes to returns, we are not just look at calendar year returns. We also look at cumulative rolling returns, where it helps us to not be blinded by a single year performance or a single year hero. When it comes to risk, it's not just about standard deviations or volatility. We also look at downside volatility. We also look at maximum drawdown. For an example, if a fund can generate a very, very good return, but when it comes to risk, it did a very, very poor job. Eventually, it will lower the ranking in our models. And you can see from the table here, for bond funds, we actually pay less emphasis for performance, but we pay a higher emphasis on risk and expense ratio. Why? Because bond funds is for capital preservation, where it should serve you as a portfolio stabilizer to give you stability and defensive. Now, simply look at this number cannot tell you the whole picture. So, other than quantitative, we do have qualitative metrics that includes portfolio positioning, fund size, and management team. So we as a platform, we have the advantage to directly inquire or ask the fund managers, how do they see the market, or how are they going to position the funds? So similarly, when it comes to sustainability, you can see that if a fund do have a very small fund size and it struggles to grow, that will raise the concerns of a long-term viability and also liquidity risk. And in that case, it's very risky for our investor to tap into that. And these three made up our qualitative parameters. So just now I have talked about quantitative. Quantitative simply means quantity. It's all about numbers. But in this slide, what I want to say is that FSMOne, we look beyond just numbers. We look at quality of the fund. So while you put this together, both quantity and quality, that's our methodology. Now, one of the things that I would like to highlight in our recommended funds, taking 2024-2025, our last year recommended fund list, from the table here, you can see that 76 of total recommended fund last year, they are able to deliver alpha. What is alpha, you may wonder? So simply alpha means excess return that the funds can give you compared to all other funds out there on our platform. So you can see that last year there are 34 funds be able to give you excess return or so-called extra return at approximately 2% annually over the past 3 years. Now, for an example, if let's say our funds on our platform can give you 5% return annually, then our recommendation fund, 76% are able to give you extra 2% more per year, like 7%. And to break it down, you can see that for equity funds, we are actually delivered 2.4% more returns as compared to other funds in our platform. And for balanced funds, 0.5%, for fixed income fund, 1.1%. Now in this chart, you can see there are a lot of fund names, where those are some of the names that have been our winners for at least 3 consecutive years since 2009. So from the heat map, you can see there are a lot of numbers here, 14, 9, 5, 4, and 3. What are those numbers mean? So simply taking Aham Select Balance Fund as an example, it means that since 2009, in a span of 16 years, the fund has been selected as our recommended fund for 14 times. And notably, you can see that for funds highlighted in blue, they actually have the most pick compared to equity funds and other funds. So that simply means that as a portfolio stabilizer, it can give you consistent and stabilized return. Now, we have gone through all the parameters, be it quantitative and qualitative, and we have been emphasizing consistency. So this year, out of our 43 recommended funds, we are total 10 new winners. And 24 of them won more than 3 times in the past 10 years. And this is our recommended fund list for 2025 and 2026. And all the funds you are seeing right now represent core equity funds. And there are new winners that you can see from the list over here. To have a quick introduction, first, for the global core equity, we have MUMG Global Dividend Funds, where this is a fund that fits into JP Morgan Global Dividend Fund, where the fund has a similar exposure to the MSCI World Index, has a higher exposure on US, especially tech, to name a few like Meta, Microsoft, and Broadcom. And global emerging markets, this year new winners comes from M Global Emerging Market Opportunities. For Asia ex-Japan, this year we have a more growth-oriented winner from Principal Asia Pacific Dynamic Growth Fund. Notably from the list here, you can see that there are major changes within Malaysia Conventional and Malaysia Sharia Compliance Fund. So while we still like core income, this year we have Maybank Malaysia Value Fund. This fund has a different methodology, investment strategy, where they have a greater focus on those big caps, those cash-rich companies, for example, those banks names, those construction. Whereas in terms of the Islamic funds, there are 2 new winners, PNB Dana Bestari and also Principal Islamic Enhanced Opportunities Fund. Well, these 2 funds has a pretty similar exposure where they allocate more on the industrial sector. But apart from that, PNB Dana Bestari Fund, they have a greater exposure on constructions for names like Suncons, IJM, whereas for Principal Islamic Enhanced Opportunity Fund, they are more like utilities companies, where their top holdings being Tenaga, which is the one we are familiar with. Now, for those who are more income seeker, you can always consider our Malaysia Core Fixed Income, where within Malaysia Islamic Core Fixed Income, we have new winners come from Principal Islamic Lifetime Support Fund that have proven consistent track record over the years. Now, supplementary portfolio. For Greater China, this year we have Manulife Investment Greater China Fund, where they have approximately 30% exposure on tech. To name a few, those names we are familiar, for example, Alibaba, for example, Tencent. Within Europe, we have winners come from M European Equity Alpha. And for Malaysia, small to medium company, this year we have Aham Aiman Quantum Fund, where they have more lower expense ratio and also a lower drawdown and have a higher rolling returns compared to peers. And here comes to our last part of our recommended fund list. So you can see that there are no changes within supplementary fixed income space as well as PRS funds. where you can see that the winners here continue dominating the board. So as we conclude our recommended funds list here, in the recent years, we have noticed the emerging trends or emerging buying interest within ETF. So we as a platform, we recognize the need, we understand how important it is to let our investor to know what do we see and what ETF do we favor. So for your information, there are over 12,000 ETFs available across the world. Where at FSMOne, total 6 countries, 9 exchanges are available on our platform, which provide you more flexibility and also accessibility. Now this year, we have scoped the ETF list down to 44. That's what we call ETF focus list. So similar to our recommended funds, when it comes to ETF selections, we also have quantitative and qualitative methodology. So in terms of quantitative, that comes with expense ratio, liquidity, and tracking errors. For expense ratio, of course, we want a lower expense ratio. Simply, it can translate into higher returns. Meanwhile, liquidity, that refers to how easy you can buy or sell your ETF quickly. So the higher the liquidity, the easier you can enter or exit your ETF positions with a favorable price. And also, when we look at liquidity, right, we will have a greater focus on bid-ask spread as well as trading volume, because that tells you how many buyers, how many sellers are there for you to easily buy or sell your ETF. And last but not least, we do think that tracking error is very relevant for you as an ETF investor. So as primary objective when you invest in passive ETFs, that's basically for you to track or mirror the underlying index. So in that case, you do not want your ETF performance to deviate much from the underlying index. So in that case, we want a low tracking difference as low as possible. So similar to our recommended funds, we have qualitative parameters for our ETF as well. First, choice of index. When we select our ETF, we want to make sure the benchmark that we choose is a good representation of a market or sectors that the ETF is intended to track. For example, if you like China Tech, in that case, Hang Seng Tech would be a more viable option than just Hang Seng Tech. It would be a more viable option than just Hang Seng Index. Well, when it comes to ETF structure, we have physical ETF and synthetic ETF. Physical ETF, to name a few, those names will be familiar: VOO, VMH. Those are the names that hold the actual underlying securities that make up the index. And in terms of synthetic ETF, simply it means that they rely on derivatives, for example, swap, to replicate the underlying index performance. But that exposed to a greater counterparty risk. And last but not least, listing locations. So for your information, for those Irish domicile ETFs that listed on a London Stock Exchange, they would have a low withholding tax standing at 15%, and that was compared to US listed ETFs that stands at 30%. And last but not least, different exchanges do give you different bid-ask spreads, so that's where we will pay a focus on as well. So now here are the list of our ETF focus list for 2025 and 2026. And the list that you are seeing now represents core equity ETF. So remember just now Jane's presentation, one of the key takeaways that she gave was the key now is at this current juncture, global diversification is key. So if you agree with that, for global core equity, the VT ETF is the viable options that you can consider. Meanwhile, if you would like to invest in US, we have two options for you, SPYL and VOO. These are the two index that tracks S&P 500, where the main differences is that for SPYL, they actually listed on the London Stock Exchange, and we have accumulation classes as well, which means they will reinvest all the dividends that you earn from the index for capital gains and as well as a compounding effect. And we have been like US Tech, So who those who would like to tap on the digital economy, then PNQI would be an option for you. Where for those who would like to tap on the semiconductor space, SMH would be our recommendation to you. And last but not least, for those who want to track Japan Index Nikkei 225, the SDJP is also our recommendation to you. Now, for those who are income seeker, here are the fixed income ETF that you can consider. And stepping into 2025, we all know that this is a very volatile year. So in this year, we see gold price reach all-time high. So for those who would like to tap on exposure to gold, GLDM ETF would be the recommendation for you. Now, for those who echo with our house view, where we have made regular updates and have assigned star ratings to the respective markets, these are the ETFs that you can consider to invest in. And we have made several technical calls in this year. For example, China Tech, for example, China EV, for example, Europe Defense, where we all know that Europe has lifted their defense spending. So for those who would like for those who agree with our view and would like to invest in, then these are the ETFs that you can consider as well. So as we conclude our ETF focus list here, for those who were here with us in the past 2 years, we used nasi lemak, we used nasi kandar as a portfolio illustration. But in today's world of investments, similarly like those when we go to buy our own nasi kandar and also the chafan, all of you may pick different dishes. So our list today, be it ETF focus list, be it recommended funds, I do hope that it serves as a guide for you, so that when you are standing in front of those very fierce auntie uncle calculating how much you have taken for your rice, I think in that case you have a guidelines for you to know where you can stop from. And everyone do have different formula when it comes to core portfolio, when it comes to supplementary portfolio, or even tactical play. There's no right or wrong. But I do hope that today at FSMOne, our recommended fund list as well as ETF focus list could serve you as a very, very good investment guide for the remaining of the year. And if I were to offer or give an advice to all of you or to all of us, I think we all need to know that the biggest risk of all is not taking one. And that serves as a very, very good reminder for me and you as an investor. And that's where I end my presentation today. Thank you.